unfolds. But hopefully it'll be a good lesson learned for the industry as a whole. I think the key defense for investors and in general in terms of reestablishing confidence is really to stick with a sound and well-footed investment philosophy. In our case, we tend to target what we think are high-performing, high-quality companies over time. We rely on our internal research to help root those ideas out. And we try to implement those ideas through a very structured process where we know where our risks are aggregating up in a portfolio. And as I said, our objective is really to target high-growth, high-quality companies that are reasonably valued. And yeah, you'll tend to see in a lot of our core portfolios companies that are in the industry leadership spectrum. You know, they tend to dominate a space that they're in, whether it's the largest market share, the biggest margins, the highest growth rates. We tend to look for comparative advantages and try to bet on management teams that have executed well in the past. We tend to be skeptical when management teams try to talk about change or transformation and want to see something showing up in the numbers. I think this sort of refocusing back on the core and what's worked in the past will work in the future is something the industry is likely to sort of take another look at and say, yes, I don't want to necessarily buy change if I don't believe change. And lastly, a clear focus on risk and how we're taking risk. We talked a little bit about back to basics, you know, in terms of our fiduciary responsibilities. At the industry level, we have noted, and I think there will be, a swing back in terms of more traditional products. I will temper that by saying, though, that there will also be a relook at risk tolerances across the industry. So there'll be a combination of more traditional cash type of product being represented in the industry moving forward in our view. And then at the same time, a more dynamic look at asset allocation products with a view that risk needs to be looked at not just at the inception of a product, but across the product life cycle and across an investor life cycle. We're certainly spending a lot more time internally looking at that latter issue in terms of how we're positioning for the future. And as I said, you know, strong standards, discipline around execution and compliance, and lastly, robust performance measurement and monitoring and risk monitoring are really what's required over time to continue to be relevant to the investor base that you all face up against. We'll talk briefly around the area of new ideas. What we have done as a firm is we put in place a dedicated asset allocation unit that just focuses on asset allocation strategies. We previously had done that as part of our broader investment process involving the different team heads, fixed income, equities, et cetera. But we took a view that we wanted to introduce a broader range of products with a sharper focus on risk. And this team has come into place, was formalized early part of last year. And as a result, we will be looking at the nature of products, the asset allocation of products on a much more active basis with the view that you can't just sort of, it's not a one-size-fits-all. Risk and correlations are not constant, so we need to be much more active in that space. And we are looking to develop more products that are more risk-targeted. Lastly, on distribution, before I come back, conclude with some of our market views. On the distribution side, you know, I think there are a couple of interesting things to note. I think the biggest issue, obviously, is mis-selling. This was an issue that was obviously surfaced in Hong Kong, as well as in Singapore, specifically in relation to structured products or mini bonds as a more specific example. This is an interesting survey. The HKMA had conducted a survey in 2008, and you know what is shocking is the sheer number of complaints. And this scale is not linear, incidentally. This is 20,791 complaints received by the HKMA in the second half of 2008. This is the time when the Lehman problem surfaced and when a lot of retail products, lo and behold, found they had exposure to the mini bond or to Lehman bonds or Lehman debt or through mini bonds and other type of structured instruments. And this is something that all regulators have taken fairly seriously. I hate to say it, what had happened over the course of the last 5 years leading up to the crisis, investment banks were out there looking for the weakest links in regulation globally, whether it be capital in the banking systems or whether it be product risk in terms of putting products into the retail markets. And a lot of these products came to Asia. A disproportionate amount of products came to Asia for investors that were yield seeking and not fully appreciating the risks underlying. I have to say, you know, Malaysia was fortunate in that regard. I think that they took a more prudent view on risk and did avoid a lot of the problems that were experienced in some of the markets that were moving faster. I will jump over this and want to highlight this one. This is an example, again, coming out of Hong Kong. Only 32% of respondents, or less, a third of respondents approximately, understood the products they had invested in fully. In other words, more than, the majority of investors had no idea about the risk profile and the return profiles of the various financial investments they were making, according to the same survey. A couple of other points that are interesting. Only a quarter, roughly, of all respondents had fully read through the documentation in relation to what they were buying. I guess in an environment where as long as something is disclosed, the investors are supposed to understand the risk, and that is tended to be the case in markets like Hong Kong and Singapore. As long as it's disclosed, the financial institutions have discharged their responsibility in terms of meeting the needs of the market and not being liable for mis-selling. Clearly, this is something that will not be going on in the future. Institutions are going to be told that they're going to be responsible for making sure those products are suitable for their investors. And I think we'll come back to that in a minute. In Malaysia, I think you've gone into an interesting route in terms of the mutual fund space. You're putting a volatility or risk rating on all funds, as I understand it. And I think that is an appropriate starting point for a dialogue with an investor. That you need to understand their risks, you need to have a view on the risk of a product, and you need to make it very public where that product sits on the risk spectrum. So I think you're going to see more moves along in this direction in relation to addressing the suitability of products for investors as we go forward. I guess in the issues of consumer protection, there is a debate in the U.S. as to whether I think there's a uniform agreement that there needs to be more efforts done to set up a consumer protection agency specifically targeted at the financial products. The question, I guess, is where that agency will sit. I think the consensus seems to be it's probably going to be an FDI, a Federal Reserve responsibility in addition to their responsibilities to police the banking system. I think you're going to see many more similar efforts across, whether it be Singapore, Hong Kong, or the UK through the FSA, as well as we go forward. Mis-selling, is signed documents are not going to be viewed as an out, I think, in the future. In law, you have the concept of reciprocity, and when you enter into a contract, you have to, if you're giving away concessions to a partner, a counterparty, there should be reciprocal concessions on the other side. In financial services, this has been taken for granted, and I think as long as it's documented, that contract was viewed as valid. I think the concept of reciprocity will probably be applied more actively to the types of contracts and the way those commitments become obligations down the road, particularly with regards to retail investors. I think this is a quote from one of the senior directors at the MAS in terms of the industry as a whole needs to carefully reflect on the findings of some of the studies and take immediate steps to win back the trust and confidence, and he's referring to investors and customers, to avoid problems in the future. I think this is the core of what's happened and what's required on the part of both the industry on the distribution side, the product side, as well as the regulators ensuring that there are proper procedures in place. And clearly the MAS is very focused on this issue, as obviously is the Fed. Looking ahead now, reasons to be positive. I left you with a lot of the challenges, I think, and some of the solutions. I want to talk a little bit about what our views are as we go forward. We have seen, as we talked about earlier, the stabilization of financial conditions. That's translated into an improvement in the real economy, and we have seen that in leading indicators and actually even improvements and turnarounds in GDP growth or economic growth and activity off of low bases. And we are likely to see, as I said, continued resilience in the corporate sector. We have started to see that in the last quarter reportings out of the U.S. Corporate sector, that the large corporates have been able to manage down costs, maintain margins, or improve margins, and have basically remained relatively resilient through this downturn. Surprisingly resilient, I would argue. Volatility or risk has come in.